Hi everybody, my name's Dimitri and welcome to webinar 2 of our Finance for Non-Financial Managers course. Before we begin, Community Business Bureau acknowledges the traditional owners of country throughout Australia. We recognise their continuing connection to land, waters and community. We pay our respects to them and their cultures and to elders past, present and emerging. So you may recall from webinar 1, just to give a quick recap, that we provided a course overview of what the 8 webinars will look like over the online course. We then had a look at specifically financial terms and the financial terminology that is often used when discussing finances. We spoke about general financial terms, we spoke about profit and loss, we spoke about balance sheet terms, and we spoke about cash flow terms. You'll see in this webinar that a number of those terms and principles that we discussed will now come through as we build on the previous webinar. So in this webinar, we're going to have a specific focus on the financial statements and in particular the profit and loss, the balance sheet, the cash flow statement, and then how they all relate to each other. So to start with, what are financial statements? Financial statements are written records that report the business activities and the financial performance of a company or organisation. The 3 key financial statements include the profit and loss, the balance sheet, and the cash flow statement. The reason that financial statements matter is that they provide a uniformed structure to record performance. It would be almost impossible to be able to read the financials of an organisation if each organisation had their own way of reporting, their own structure. So financial statements provide that uniformed structure to record financial performance and health. This then allows multiple parties, regardless of their day-to-day involvement in the finances of the organisation, to evaluate the performance and financial health of the organisation. So we're talking here about boards, senior management, regulators, all have very different involvement in the day-to-day operations of the organisation, but financial statements will allow those people to get across the finances of the organisation. And last but not least, financial statements are required by regulators. In particular here, we mentioned the ACNC. So without an understanding of financial statements, it can be really difficult to evaluate financial performance and health. Communicating the results of financial statements is difficult when you don't understand the financial statements or the picture that they're painting. This can make mistakes harder to identify and financial decisions more difficult to make. And it's worth noting here that without an understanding of being able to read financial statements, you could fall in the trap of being in trouble and not actually knowing you're in trouble until it's too late to do anything about it. So by the end of this webinar, you'll understand the 3 key financial statements, be able to explain how the 3 key financial statements differ from each other, and know how the 3 key financial statements relate to each other. So the first statement that we're going to look at is the profit and loss. So the profit and loss is a financial statement that summarizes revenues, expenses, and then shows either a profit or a loss. It is activity-based, which we will touch on more in the coming slides. And it shows earned revenue and expenses spent to provide an insight into the performance of the organisation. So the profit and loss is, to recap, activity-based and performance-based. It is for a period of time. So a profit and loss is always for a period of time. So usually a year, a quarter, or a month, but it's worth noting here that with modern accounting technology, it can be for any period that you like. It can be a day, 2.5 months, 37 days, whatever you choose, but it's always for a period of time, a very specific period of time. The profit and loss only shows income and expenditure. So cash, assets, liabilities, not shown on the profit and loss. The basis of accounting, which we spoke about in the previous webinar in terms of accrual accounting versus cash accounting, absolutely impacts the profit and loss, because if you are running on an accrual basis, then items will appear on the profit and loss as they are incurred. If you are operating on a cash basis, then items will only appear on the profit and loss as they are actually paid for or the cash is received. So this absolutely impacts the profit and loss. And this is the main reason that profit does not always equal cash. Without getting too technical, you could have a situation where you have generated a substantial amount of revenue and are operating on the accruals basis. In that instance, your revenue would be showing on your profit and loss, and you'd be showing a great performance, for example, but you may not have received the cash yet for that. And because you're on an accruals basis, it's being recorded. And that is why profit does not always equal cash. So the profit and loss is presented as shown on the screen. It's, I guess the first point to note here is you'll notice in the heading that it's that we've got interchangeable terms in terms of income and revenue. So interchangeable terms, which we spoke about in the previous webinar. So top to bottom, you will have obviously a heading at the very top, and again, it will highlight when the period for the profit and loss is. So you'll see on this one, it's for the period ending 30 June. So that's the 12 months ending 30 June. We then look at income or revenue at the top, and then going down, we'll have revenue, other, usually non-operating revenue. We'll then have our cost of goods sold. We'll then have, which will then produce a gross profit to allow a gross margin. We will then have expenses, interest expenses, depreciation, which will finally produce either a net profit or a net surplus. So what you'll see here is that we're using a number of the terms that we covered in the previous webinar. So what to look for in your profit and loss? This will sound quite basic, but the very first thing to look for is the period of time. Often at times you might look at a profit and loss and think, geez, the numbers are low, and inadvertently you're looking at a 1 month profit and loss rather than a 12 month. So always look for the period of time. Is it for a month? Is it for a quarter? Is it for a year? Have a look at specific revenue items. How has this organization generated revenue? Have a look at specific expense items. Are there any major expense items in there, such as salaries and wages or rent costs? And then finally, when taking into account all of the revenue and all of the expenses, does the organization produce a profit? Is it operating at a loss? These are the things that you'll be able to see. And again, it's for the period of time. Once we get a bit more advanced, which we will cover later on in the course, we can then look at gross margins, which will account for how much profit is made, taking into account the cost of sales. We can then look at earnings before interest, tax, depreciation, and amortization, which will show us our profit before tax, depreciation, and amortization. And we can also look at net profit ratio in terms of how much money is being generated as a profit per dollar of revenue. These are things that we will cover later on in the course, but just gives a little bit of an idea of where we're heading. So one way to look at profit and loss and to have another understanding of it is to think about your own personal finances for a second. So every single person could have a profit and loss. So what do we mean by that? So you as an individual are usually, if you're working, or have other income in particular ways are generating revenue. So your revenue items could include your wages and the income that you get. It could include, say, if you have a rental property, it could include the rental revenue that you get from that property. And then what are your expense items? Do you pay a mortgage? Do you pay interest on your mortgage? Do you have electricity bills? Do you have phone bills? These are expense items. So although it's a little bit unusual for people to have their own personal profit and loss, when thinking about a profit and loss and thinking about the terms and things like that, cast your mind for a second to what your own personal profit and loss would look like. Think about your revenue items, think about your expense items, and then think about what the net profit, or hopefully not in this case a loss, but think about what the net profit would be when you take your income and you subtract all your expenses. That would essentially be your own profit and loss. So prior to this webinar, you would have received correspondence on obtaining a copy of your own organization's financial statements. So with those in front of you, refer to the profit and loss of your financial statements and just have a look at some of the quick questions here. So what period of time is the profit and loss for? Now, chances are that if you've got an annual statement, that it'll be for 12 months. So that first sentence might read something like, the profit and loss is for the period 1 July, say 2019 to 30 June 2020. Look at the revenue for the period. What was it? Look at the expenses for the period. What was total expenses? Did the organization make a profit or a loss? Have a look at it for the period. And then from there, you'll be able to say. Now, the key thing to note here is not just looking at the numbers, but specifically looking at the period as well. This is particularly important if you're reporting throughout the year. You might be looking at, say, a 1 month profit and loss, or you might be looking at a quarter profit and loss, or even a 6 month profit and loss. So the period is very, very important. A little bit more advanced, you might have a look at your gross profit margin. If your organization has cost of sales, you'll be able to see what's your revenue less the cost of goods sold to give you a gross profit, and then it's that divided by revenue. Equally, the organization's net profit divided by revenue will give you your net profit margin. Again, those last two are a little bit more advanced and we'll look at later on. The second statement that we're going to talk about is the balance sheet. So the balance sheet is a financial statement that reports an organization's assets, liabilities, and equity. It shows assets owned and liabilities owed to provide an insight into the financial health of the organization. So the balance sheet is always at a particular date. So the profit and loss is always for a period of time. However, the balance sheet is never for a period of time. It's always at a particular date. It's usually the last day of the financial year. So it might be as at 30 June. It could be the last day of the quarter. It could be the last day of the month. But again, with modern accounting technology, it can be any day that you specify. You could make it today, you could make it last Tuesday, whatever it is that you want. So the balance sheet is assets and liabilities and equity only. Income and expenditure are not shown at all on the balance sheet. So we spoke previously how the profit and loss doesn't include things like cash, and that's because they're included on the balance sheet. Again, your basis of accounting will impact how your balance sheet looks. So on your accrual basis, you will have things such as debtors appearing on there. On a cash basis, only when the cash is received or has left the bank account will it show. And that's why cash may be low, even though business may be good, that impact of accrual accounting. So the presentation of a balance sheet appears similar to what is on the screen in front of you. So the first thing to note is that you will see the title, which says as at 30 June. So it's not for a period, it's as at. We then look at the current assets, non-current assets, which will then give us total assets. So you will recall from the previous webinar that we spoke about the difference between current and non-current, current being to be consumed within the next 12 months and non-current unlikely to be consumed in the next 12 months. So that's why things such as cash, debtors, stock will always sit in current assets, and non-current assets will include things such as computers and office equipment, things like that you're likely to be holding for more than 12 months. So the general structure is current assets followed by non-current assets to then give us total assets. We then look at current liabilities, non-current liabilities to give us total liabilities. And the difference between your total assets and your total liabilities will then give you your net assets. So what should we look for? Well, the first thing is to look at the date. Is this a current balance sheet or is it something from a while ago? So as at what date is it? We want to look for specific asset items. So what are the assets that sit within this organization? Does the organization mainly hold cash? Does it have a lot of debtors? Is it holding a lot of stock? The asset items will show you what assets the organization is holding. And in terms of liabilities, what liabilities does the organization hold? Does it have a lot of debt? Does it have a lot of creditors that it needs to pay? And of course, the difference between your asset position and your liability position will give you your net asset position. So just to prelude into future webinars, we'll be talking about how current assets and current liabilities are used in an analysis going forward outside of the scope of this particular webinar, but it is very important that items are split appropriately between current and non-current. So again, similar to a profit and loss, everybody has a personal balance sheet. So assuming that you own something, could be anything, but you will have asset items. So if you own your home, that would be an asset item. Do you own your car? That would be an asset item. If you have jewelry, for example, that would be an asset item. So think about all the things that you own, they are your asset items. And in terms of liabilities, what do you owe? Do you have a mortgage? Do you owe the bank? That would be a liability. Do you have credit card debt? That would also be a liability. And then of course, the difference between your asset position and your liability position then gives you your net asset position. So a simple way to think about this would be if your house is worth, to use a round number, 500,000 and you owe 300,000 on it, then your asset position would be 500,000, your mortgage 300,000, and your net asset position 200,000. So we all have our own personal balance sheet. And again, a little bit unusual to be running your own personal balance sheet, but it's worth putting ourselves in this mindset to understand how particular items move on a balance sheet and where they sit amongst the three financial statements. So again, referring to your organization's financial statements, have a look at the date on the balance sheet. So if it's last year, chances are that it will be as at 30 June, say 2019 or 30 June 2020. So the date as at. Have a look at the current assets. What were the current assets at that particular date? What were the non-current assets at that particular date? What were the current liabilities at that particular date? What were the non-current liabilities at that particular date? And then having a look at overall total assets and total liabilities, what is the net asset position at that particular date? So the third financial statement that we'll talk about is the cash flow statement. So the cash flow statement is a financial statement that summarizes the amount of cash entering and leaving a company or organization. The cash flow measures how well an organization manages its cash position, specifically how well it generates cash to meet its obligations. So a cash flow statement is always for a specific period of time. So the same as the profit and loss, it's for a specific period of time. And again, usually a year, a quarter, or a month. However, with modern accounting technology, it can be, again, any period that you specify, a day, 2.5 months, whatever you choose. The presentation of the cash flow statement is as shown on your screen. And again, this will sound basic, but I'll always refer you through to the title. It's vitally important that the title is read first and foremost. So in this example, you can see that it's the statement of cash flows for the period ending 30 June. So we have the headings, and then we have our operating activities. So these are the day-to-day operations that the organization does to generate cash and the ways in which it spends money through its day-to-day activities. It's then broken into investing activities. So these are specifically activities that are relating to an investment type activities. We then have financing activities. So things such as bank debt will flow through that, which will then leave us with a closing cash position. So what to look for? Again, look for the period of time. Have a look specifically at the operating activities. These are the day-to-day ways in which the organization generates cash and spends cash. So look at the net cash from operating activities. Have a look at the total net increase or decrease in cash. And of course, have a look at your closing cash position. So your organization's cash flow statement, open that up. Again, it should be part of the financial statements that you have in front of you. And again, look for the period of time. Have a look at the operating activities. What was the net cash from the operating activities? What was the net increase or decrease in cash for that particular period? And what was the closing cash position for that period? So how do these three financial statements, being the profit and loss, the balance sheet, and the cash flow statement, all relate to each other? So they paint a whole picture, a whole financial picture, if you like. So the profit and loss shows financial performance, specifically how was the financial performance over that specific period of time. And the balance sheet shows the financial health at a particular time. Together, we can see how financial performance over a period of time and overall financial health are. So referring back to a personal example for this, if you imagine that your income doubles in the next 12 months, then your personal profit and loss would most likely look quite healthy. You would have twice the revenue. Things would be good. From a financial performance point of view, you're generating more revenue, more money, things are going well. But this is only for 12 months. Your overall financial health, say if you were coming out of bankruptcy or something like that, may not be good. However, if your financial performance is really good for 12 months, then chances are that it will positively impact your overall financial health. So what do we mean by that? If you had a really good year personally and your income doubled or tripled, then that would be for that. However, your financial health may also significantly improve as a result of your financial performance. So you may pay down a lot of debt and pay off your mortgage. Your superannuation, which is an asset that you hold, could significantly increase. So financial performance directly can impact your financial health. It all comes back to cash. So if you trace every transaction back to cash, you can see how particular transactions flow through the three financial statements. So for example, without getting too technical, when a sale is made on credit, and we're assuming in this instance that we're using the accrual basis, when a sale is made on credit, revenue will increase, and debtors or accounts receivable on your balance sheet will increase as well because money is owed to you for that sale. So we've hit the profit and loss, and then we've also hit the balance sheet. When that money is paid, when your customer pays you the money that they owe you, the debtor is reduced. So your balance sheet decreases, and then the cash flow increases as the cash has come into the organization. So it's a little bit beyond the scope of this particular webinar, and it can get quite technical when we're talking about three-way forecasting and tracing transactions through all three of the financial statements. But it's worth noting here that if we do trace transactions back to cash, we can almost always see how the three financial statements relate to each other. It's also worth noting here that if you know two of the three financial statements, you can work out the third. So for those of you that have done any sort of maths, you'll remember simultaneous equations. And when you have when you have three variables but you know two, you can work out the third. And that's very much the case with financial statements. You only need to know two to work out the third. So that brings us to the end of webinar 2. I hope that's given you a good understanding of the three financial statements, how they relate to each other, and some good personal examples to give you a deeper understanding of what exactly makes up a financial statement and why they're made up the way that they are. Thank you.